Hey guys, Philip here. Now, a lot of you love trading gold. It's a very, very popular pair. It's a very popular, obviously, commodity. It's a safe haven when we see a lot of US dollar weakness. And so it's an incredibly volatile pair at times. And it likes to draw a lot of you in because of, the amount of money you can potentially make on it. But obviously on the flip side, the amount of money you can also lose if you get it wrong. And I've made this video today to really sort of get some clarity for you guys, put away all the noise and all the mess that's surrounded with gold, so we can give you a much more concise, in-depth plan of how to start systemizing trading gold, because it catches a lot more of you out than it doesn't. A lot more of you are losing on gold than you are actually winning in terms of over a period of weeks or months or even years. So keep watching, because I'm sure you're going to absolutely take something away from this today. So let's get stuck in. Focus on higher time frame structure every single day of the week. This is where I see the biggest mistake amongst traders, wannabe traders, people in their early infancy stages of trading, on people who have even been in 2-3 years. You're trading off lower time frames too often. You're neglecting higher time frame structure. You're not even sometimes considering or looking at higher time frames. Start on gold from the weekly and the daily, mark up structure, mark up, are we bullish, are we bearish, just to start off simply. Look at how structure is trading, and if we can get the daily and the weekly in sync, so both the weekly and the daily are both trending bullish, for example, then already you're making life a lot easier for yourself, even if you then proceed to go and trade the 5-minute or the 15-minute. My advice would always be to trade higher time frames on gold. Obviously, you should always do your analysis on the higher time frames, because Confluences are a lot more respected on higher time frames, and the likelihood and the probability of your trade playing out, if it's a higher time frame play, a higher time frame trade, is much more likely, because the higher time frames give us the overall bias and it gives a lot more clarity on where the market's going. So once you have that higher time frame structure in place, let's say for the example of this video, we are currently bullish, then you can start to scope an area of interest out. Now, the beautiful thing about gold is actually it trades and swings pretty cleanly in terms of price action and structure on the higher time frames, at least. I never drop below the 1 hour, but most likely I'm on the 4 hour, the daily and the weekly, and I stick to those 3 time frames, and I'll drop down sometimes to the 1 hour to execute. So we've established high time frame structure. We have a overall bias of whether we are bullish or whether we are bearish. We now need to look at then utilizing confluences and to establish A, an area of interest, but B, market sentiment and the overall sentiment of where gold may potentially be going. So what I mean by this is start utilizing the DXY, okay, the dollar index, okay, that gives us overall sentiment in terms of US dollar strength or US dollar weakness. Now, as I said at the start of this video, gold is incredibly sensitive to US dollar strength and weakness. Gold is obviously seen as a safe haven for investors and traders when the US dollar is looking bearish. And you'll typically see when US dollar weakness is about, we will see gold pump and we'll see gold be very much bullish on higher time frames. And not enough of you even know about utilizing the DXY as a major confluence, if not your biggest confluence when scoping up a trade on gold. But not a lot of you know about it, or those that do don't know how to utilize it properly. So again, get onto the DXY, the dollar index. You can happily find that on TradingView or whatever platform you use. And on the dollar index, the DXY, you're going to do exactly what you just did on gold. You're going to hop onto the weekly, you're going to hop onto the daily, and you're going to work out structure. Are we trending bullish? Are we bearish? Is there a confliction between the weekly and the daily, which we do see? Of course we see that. And again, so for example, if we use my example from earlier, if the gold chart is looking like it's bullish, we would expect to see the DXY on higher time frames looking bearish. Now again, this is not all the time, but when we do have that really good correlation when the DXY is bullish and gold is bearish, which is what we'd expect, when they are in sync, then again, that's one of your most highly probable setups, highly probable probabilities from playing out, because again, the DXY is bullish and gold is also looking bearish on higher time frames. So we have the weighting of the DXY to really help and really give us that clear understanding. Actually, you know what? Those higher time frames on gold do make sense because of the higher time frames on the DXY and that inverse correlation they both have with one another. Now again, for a lot of you, you may not use Fibonacci levels. I do typically. They have a long history in the market of respecting very similar levels. They have a long history of data behind them, and we know over many years of market history that these certain fib levels are respected really well. Now, depending on the instrument that you're trading, you know, it could be an indice, it could be a commodity, it could be a foreign exchange pair. It doesn't matter too much. Fibonacci, you know, sequences, Fibonacci levels, retracement levels work incredibly well, as I just said, across all markets. And so if you're not using a fib level, there will be a video I'm dropping on this very soon. But if you're not, or you've been playing around with a little bit of fibs, now's your time to definitely start implementing them and using them seriously. So on gold in particular, certain fib levels aren't very respected and certain fib levels are. And again, if we go back to that higher time frame point, if you're using, well, I personally just draw my fib level on a weekly and a daily, and normally they'll mirror, there'll be a fib level that matches in sync. But typically on gold and the higher time frames, it doesn't really respect the 38.2 a lot, and it doesn't really respect the 78.6 a lot. And when I say it doesn't really respect them, I say on a retracement, it typically pulls above the 38.2 and goes higher. But on that same retracement, it never tends to pull up as high as a 78.6. Don't get me wrong, it will sometimes, just like in all trades, we can never be 100% accurate. But typically with gold, it will wick up into the 61.8% fib level, but body close below the 50% or in and around the 50%. Now I'm talking about the daily here and the weekly. Sometimes on the 4 hour, but typically the daily and the weekly, that's what will happen. Wicks into the 61.8, but typically body close in and around the 50%. Or if it doesn't do that, the other higher probability that it does do is that it body closes up into the 61.8 before we then see our reaction, our reverse, or what we're intending to see. So guys, use a Fibonacci level on gold, only on higher time frames, of course. That's just my preference, but for the reasons as I've said again earlier. Confluences on the higher time frames are a lot more respected. So fib levels, they're a lot more respected and have a lot more weighting on the higher time frames. Last but not least, of course, is risk management. As I said right at the start of this video, there is a huge, scope on gold to make a lot of money if you know what you're doing. But at the same time, the reverse of that, there's a lot of opportunity to also blow your account and lose a huge amount of money as well if you don't know what you're doing. Risk management for me, yes, it's super specific and helpful on gold, but it is across any type of trading you do. You'll get sick of me preaching about this. On gold in particular, you have to have your risk management to a T and to be super disciplined. So whatever you choose to risk, it could be 0.5%, 0.25, it could be 1%, 2%, 1.5. Doesn't matter too much in terms of in and around those sorts of numbers I've just given. What does matter is that you're consistent with what you're risking. Let's say, for example, for sake of example and ease of example, that you choose to risk 1%. Make sure every single trade you take on gold, you are working out what 1% is of your account balance, because your account balance will change after every trade. You need to be continually reorganizing, reassessing and remeasuring what is 1% of that live account balance you have, so you don't open yourself up to any more risk. The reason I say this as well is because when you've worked out and scoped out your stop loss size, each trade on gold won't be the same as the last trade or the next trade. It'll be a certain slightly different type of position perhaps, which means your stop loss might be slightly smaller in your next position, or it might be slightly larger. So you have to work out what 1% is, so you can adjust your lot size accordingly, so you're only risking 1%. Gold is one of those things, you can still be incredibly profitable on it, but risk management is typically where a lot of people go wrong. They get most of what I've just discussed in the rest of this video pretty bang on or there or thereabouts, but risk management just lets them down. And what people tend to do on gold, because it can affect a lot more people, psychologically, there's a lot more emotions involved with gold because of how quickly it can move. And obviously that's not the best way to trade. We need to be emotionless when we trade, and we need to be very systematic. But a lot of the time, people, when they're in a losing position on gold, they will scale in further positions in the hope it's going to come back. Whereas actually, you're just trying to catch a falling knife there, and you know what's going to happen. You'll end up losing more money than you'd intended to risk, whether that's 1%, 2%, 3%, if not a lot more. And I know if you're watching this right now, you've definitely been in that position. So guys, if you can stick to that 1%, again, you have to be wrong 100 times for you to blow your accounts. Now, if you're wrong 100 times, you probably shouldn't be trading in the first place, and something a lot more basic and fundamental is wrong if you're losing 100 times in a row. But as you've probably all heard before, you can take 10 trades in a month on gold. If you're risking 1% and a risk to reward of a 1 to 3 every trade, you can lose 7 of those and you can win the other 3, banking 3% on each of those winning trades, and you'll finish up 2% for the month. Now, 2%, yes, on 10 grand might not be a lot, but 2% on 200 grand is when you're starting to get into really, really healthy money. So guys, I cannot preach enough. Get your risk management nailed and stay disciplined with it. That's where most of you are going wrong. So I hope you found this video helpful. I could have gone into a huge amount more of detail, but if you found this really, really insightful, please leave a like, please subscribe, and check out the Instagram page as well, where I drop a lot more daily content and advice and education. The website's also in the link below if you'd like any help and direction or mentorship. You don't have to, of course, but it's there for those that want to. And I'll see you guys next week.